All right, so we've got a great session. It also feels like a changing of the guard, so maybe you should be considering changing your approach. Joining me now is SureVest CEO Rob Luna. Rob, obviously you've been bullish, and because it hasn't always been easy in this market. A lot of noise, a lot of downside. The bearish sentiment is as outrageous and nuts, but you've insisted on buying as the market was melting down. What do you feel is driving this move to the upside now?
You know, I think there's a lot of seller exhaustion right now, Charles, and what you're seeing is I think this market can move without some of the leaders that the market's needed over the last several years. We've seen just absolute debacles, starting with Google, which really was a realization to me that I think there's a big change going on, followed by Meta. Today we're seeing Amazon, but even Amazon's starting to bounce back much nicer than we've seen from the other two names. So I think there's a lot of solace in people believing, hey, maybe I could take a broader base approach, maybe a lot of the bad news and some of the bad selling is off, and so I think what you're seeing is people dip a toe back in at these lower levels right here, Charles.
So as they dip their toe in, I know you've adjusted your barbell approach.
Yeah.
What was it before? What is it now?
Yeah, what you used to give me a lot of slack about was the old barbell we were using for about a year and a half, 2 years there. And that's when you had no yield, right? So what we were looking at was half of the portfolio in those dividend grower types of names, the dividend aristocrats, which have held up remarkably well this year, down about 9%, half of the S&P, and the rest of it was those big FANG types of names, Amazon, Netflix, Google, that have really led us over the last decade. But we're changing that approach now because you're seeing yields move back up. Credit really is paying you now. High yields up there, 8, 9%, even the 10-year over 4%. So that barbell is going now to some of these credit names. So across the board, high yield, corporate, treasuries. And on the other side, I think what you have to do is look not what led us over the last decade, but what's going to lead us over the next decade. And I heard your earlier guest talking about small caps. That's something that's worked historically well over the last 30, 40 years, but the last decade has underperformed. You need to start looking at smaller names, more undiscovered, more research on that other side of the barbell.
Within that area, small caps, you know, for instance, you got the Russell 2000, but you also have Russell value and Russell growth. I mean, would you still be more specific in terms of which area, even among the small caps, you want to be overweighted?
You know, I'll tell you what I'm doing is I'm picking some individual names. I've just got back into a name I talked about before, got out a while ago, which is Farfetch. So that's a smaller name that's absolutely been decimated. And then what I'm doing is I'm kind of splitting that, and I'm using VTWO in my own portfolio. That's the Vanguard blend. So it gives me some value, some growth, because I think right now at the beginning of any new cycle, Charles, you don't necessarily get paid to pick one of those 1 or 2 names. You really want to take a little bit broader base approach, and that gives you that ETF to make sure you're capturing that larger move.
You know, you mentioned Farfetch. My godson, I saw him last week, and he said he was buying some too, so he's in good hands, I guess. Is it now? I got 30 seconds, but should we be going back now and looking at some of these disasters that, you know, they were amazing on the way up, like Roman candles, they blew up bright and beautifully and came back to earth. Should we be sifting through those, looking for opportunities?
Yeah, I think you should look at some of those names. The new gig economy, that's not going anywhere. Fiverr, you're going to have up there on the screen. Upwork, yeah, Farfetch, the names that have absolutely been decimated. And now the good thing is, Charles, you can pair those with some fixed income. That's going to give you a little bit of a volatility dampener, but don't be too conservative. And I'm thinking the Googles, Metas, Amazon, look, at these valuations, I wouldn't be selling them, but don't look at those to be the leaders for the next 10 years.
Gotcha. Got great marching orders, Rob. Thanks a lot. Have a great weekend.
Thanks. You too, Charles.